You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. We are taping Options Playbook Radio. It is Wednesday, April 6th. If I sound a little anxious, it is because the Fed is supposed to be speaking here in about the next 20 minutes. And the markets have been a little rock and roll this morning, down a couple of percentage points on most of the major indexes. And that's because the Fed, the people of the Fed came out this morning and were a lot more hawkish than anticipated. But we have the meeting and the announcement that's supposed to be kicking off here in about 20 minutes or so. So we're going to design a strategy where we're going to be a little contrarian to what's going on in the marketplace. A lot of negativity right now you hear on a lot of the news sources. And I want to talk about that strategy in detail about how I can do it, try to manage my risk using options. By the time you listen to this, the trade might have already played out. But as always on Options Playbook Radio, we're not looking to make recommendations. We're just talking about certain scenarios and how you can do options. Sometimes we're looking at a little bit longer term. We've termed a few of our trades deeper in the money option contracts. We call them FOMO trades, going out further in time. Last week, we were talking about a hedge. We looked at a fig leaf in gold, and mainly because a little bit nervous about the inflationary concerns. Obviously, we still have the geopolitical concerns in the marketplace. Have mentioned on every Options Playbook Radio for the last 3 or 4 weeks that just surprised to see the VIX trading where it is at. Right now, we have the VIX index just north of 24%. And I just feel like the marketplace is not carrying a lot of weight as to the hawkishness of the Fed, the inflationary numbers, the geopolitical concerns. So I was always surprised to see that. As a matter of fact, the 200-day moving average on the VIX index, which I like to look at as more of a line in the sand, it's more of a mean reverting type index, is only down right around the 20% level. So to me, we're just a little bit high volatility relative to the 200-day moving average in the VIX. So with that said, we're going to take a speculative trade today. The gold trade, we usually like to review what we talked about last week. It's pretty straightforward. We went out and looked at gold, and we decided that we were going to do a little bit deeper in the money option contract, going out a little bit further in time, basically a hedge for your portfolio. The stock was at 180.58, which is good old GLD, a solid ETF that tracks the price of gold. And the stock was at 180.58. Stock right now is at 179. 33, so the position really hasn't moved at all. We did sell a July 15th call, the 190 against it, against our position, and so that has helped us out a little bit. So we just saw that gold has kind of been a little bit of chop. This was a way that we could maybe hedge our portfolio by owning a few of the commodities. So simple trade, nothing to report on that front. Let's get busy. Fed's about ready to speak. They're about ready to announce. We're going to look at buying a long call spread in the SPY. So if we are looking at the SPY right now, the markets are rocking and rolling, so I got to talk fast. If I take a screenshot of it, though, we see that the SPY, it last traded at 446.60. Market is down $4.43, dealing with live markets. We're looking to go, we're going to go a little bit out of the money on this scenario. We're not going to buy an in the money spread. And relative, when I say that, it's all about the strike price that we are buying. We're going to go a little bit at the money. We're going to concentrate a lot on our risk versus our reward. And it's literally going to be a one-day trade. Now, the expiration I chose is April 11th, and that's only because I can, right? There's a little bit of time premium that's going to live in that option contract because we can go to Monday, this Monday, the 11th expiration. So if it was a normal stock, that had just normal option contracts, that expiration date would usually be Friday the 8th. But to me, that's a lot of time decay and a lot of premium risk that you might have. I love the fact that we can go to Monday the 11th, so chose that expiration. But it's purely a purely speculative play, hoping to be out of it by the end of the day today, and we get a little bit of a rally into the close. So I'm going to be very cognizant of what I'm paying for this long call spread. So here it is, April 11th expiration, stock at 446.60 in the good old SPY. We're going to be buying the April 11th 447 strike call and selling the April 11th 455 strike call. The midpoint, and it's a very tight market, is $2.83. Might actually just pay the ask, which is $2.84. Normally, we would kind of work the trade, but we're trying to get ahead of this Fed speak, which is going to be coming out here shortly. So that means for every 1-by-1 spread that we do, we're going to pay $283 plus commission to put on that trade. Now, strategically, I think what's very important here is that I went out 8 points, and that we're paying $2.83 minus the 8 points, which is the width between the strikes, means that we have an upside of $5.17 on that trade. That means that we have a decent risk reward ratio. We have a potential for an implied volatility crunch. We're going to have some large time decay. That's why I'm doing it as a spread. And it's mainly because we're doing it ahead of the Fed speaking and Bernanke's news conference that he's going to be having after their statement. So if I'm doing this type of trade, I want to go pretty wide. I wouldn't even mind going 10 points wide if I could. I didn't get enough premium by selling the 457 call, which would have been 10 points. The 455 is trading at a bid price of 68 cents. So I wanted a little bit more hedging on this trade. I would have liked to have gone 10 points wide, but bottom line is it just didn't have enough juice in it. A little bit worried about the fluctuation in implied volatility after that conversation. Now, total speculative, have no idea what they're going to say, if the downturn is priced in. But this is one way where you're seeing a lot of people being contrarian on the marketplace. It's down. It's not getting killed, relative to some of the comments that we heard about the hawkishness this morning of the Fed and what they might be looking to do going forward. The VIX being around 24 is interesting to me. I might even think about doing a long straddle. It's actually not a bad play with the VIX where it's at. And That we talked about a long straddle not that long ago on Options Playbook Radio ahead of the invasion between Russia and Ukraine. And it was the same scenario that the VIX just didn't seem to price in the risk of that pending invasion that Russia was obviously looking to do. I guess it was fairly obvious to most people that it was going to happen. And then we did have the big downturn, and quickly the markets kind of came back, and they're just in the chop mode right now. So they're just markets are just trying to really decide and discern all this information and decide where it's going to go to next. So we're going to do a very short term, very speculative, not meant to be a recommendation in the SPYs, long call spread. We get to pick the Monday expiration because we can, so we don't have to do the Friday. Gives us until the end of Friday, basically, to decide what we want to do on this trade. I'm probably not going to write it into the weekend, but I'm prepared to lose the net debit on this trade. If I enter this trade for $2.83 and I was able to execute that trade at that midpoint, I would instantly put in a sell order, and I'd make it good until cancel, even though it's only going to go till Monday, for almost about 80% of the maximum of the trade. Now, that last 10 to 20%, it's always hard to extract from long call spreads, especially on fairly expensive stocks. The SPY right now is at 446, so that's a fairly expensive stock. And when you're trying to extract that time premium out of it, which you need to maximize that spread, it's fairly hard to do. So if you take 8 and you times that by 80%, you're looking to get somewhere around 6.5, maybe 7. You're just going to leave that good till canceled ordered in, especially when you're doing it around a news event, just in case it spikes up and it gets close to that. Now, if you want to just let it ride, I'm okay with that too. But the way that I'd approach it is on the upside, I usually have a limit order to sell to get out about 80% of what the maximum would be on the long call spread. On the downside, I'm just going to let it ride because I've already managed the risk here. $2.83 is my downside, and I have and the maximum that I could sell for on the upside is the width of the spread, $8. So very simple trade, and I kind of feel like I should just go through it one last time here, and then we'll call it quits on this shortened Fed Day episode of Options Playbook Radio Podcast. So here's our paper trade for this week. We are looking to buy to open April 11th, 447 strike call in the SPY. At the same time, we're looking to sell, same expiration, April 11th, 455 call. We're looking to do this for a net debit of around $2.83. That will be our max risk plus commission on that trade. And if we do execute it for $2.83, which I'm sure the market has moved by this point in time, considering, we will make, or we have the potential to make on the upside, $5.37, which is 8 minus the net debit paid for the trade. That's it for this episode of Options Playbook Radio. If you have any topics you'd like us to discuss on the show or any questions you'd like us to address, please do email them to me at theoptionsguy@invest.ally.com. If you'd like to learn more about all the educational events that we do at Ally Invest, please follow my Twitter. It's very simple. It's at my name, at Brian Overby. And thanks for coming. We'll be back at the same time, same place next week. Until then, may all the options that you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.